Howdy, Jacob here. Today we're looking at BWX Technology in the aerospace and defense industry. 8.6 billion market cap on 9.8 billion enterprise value. Founded in 1867, it's been around for quite some time, and yet we are still seeing a very good amount of revenue increases, mid-single digit, very positive over the last 10 years, with gross and operating margin up from 10 years ago. But still, double-digit operating margin is always a very positive sign. Obviously, the business and sector depends on that, but I always like to see operating margin in the double digits. That's a good sign. Return on invested capital and return on assets historically also double digits. Another great sign. We'll see whether that's from buying back shares though, because when you buy back shares, inflates your return on invested capital by lowering denominator. So balance sheet shows 76 million cash on hand, 6 million short-term debt, 1.2 billion long-term debt. Not a lot of cash for that type of debt. I don't really like that, but if they're a free cash flow producing machine, I'm not worried about it. So 1.2 billion in relation to their 5-year average free cash flow, I'm a little bit worried. We're looking at about $100 million, maybe. Recently you're looking at 250, which is fantastic, but even 250 is still almost 5 times that free cash flow. So they're going to really have to produce the same amount of cash flow they are last year and rolling 12 for it to be not a terrible concern. But again, capital allocation is going to have to be going towards debt. How much? It's really going to depend when it's due, what the interest rate is, whether they think they're comfortable and confident in refinancing or not. But I would say I would not be surprised if a third of their cash flow over the next 7 years went to debt reduction, which again is going to reduce their ability to reinvest back into themselves, buy back shares stupidly cheap, make acquisitions that are good for the business. So it's not always, sometimes it's the best thing to do, but just remember there's an opportunity cost to it, and it's tough. Going into debt to hit the top line, is not what you want. Going into debt to hit the bottom line, if it increases your margins enough, could be fine because it's all about ratios. So if you increase your free cash flow, 50%, increase your debt 50%, the ratio is still technically the same in relation to free cash flow. But at some point, it's going to get to a point where you want to pay down that debt when you're a really stable business. And them being around since 1867, I don't think they should be leveraging debt very much unless they are extraordinarily confident in a great return. So my assumptions here, I'm going to go 6% on the revenue side. I just don't remember. I don't really see that much share purchases. So it looks like they do actually have a pretty good return on invested capital. So let's give them a slight premium on the P price to free cash flow. Margins on free cash flow being as low as they are, though, does not make me very happy. Let's do a little range there. Me and being generous, I think. Coming on the share change, 1% would be about 80 million, 100 million to offset stock-based compensation. I think they offset stock-based compensation with about 10% of the free cash flow, but that's it. The dividend paying out 86 million, 1%. I don't want them to increase that either, because again, we're already at 50%. So a third to dividend, that just leaves about a sixth to, about 15 to 20% to reinvest, make acquisitions. And I think I'm comfortable with that. So we're saying the stock price needs to fall very heavy before you get the return we're looking for here. Again, I'm a free cash flow guy. I'm a value guy. With free cash flows as low as they are right here, I'm just a little skeptical. And valuation as high as it is, I'm definitely just a little skeptical. But business itself looks fine. I want to get it at the right price. And I don't think this is it. So hopefully you enjoy the video and have a great rest of your day. Thanks.